All right, so I wanted to get into a little bit about the differences between our cost flow methods when we consider just overall trends, what they do to income, what they tend to do to companies' inventory profits, things like that, during different inventory cost regimes. But it's first easier to make sure that we understand how LIFO and FIFO affect our cost of goods sold and our ending inventory. So for our goods available for sale, remember, goods available for sale is everything that we started with. Oops, not GAF. So I was almost doing GAP, I guess. GAFS is comprised of beginning inventory and adding my net purchases. And remember, net purchases is the combination of freight, the sticker price of our inventory, and any discounts or returns that could affect what our dollar value of net purchases are. That gives me an amount of gas. Gas then is basically a combination of ending inventory. And by ending inventory, of course, mean the inventory balance of the asset account inventory and cost of goods sold. And why does that make sense? That GAFS really is just the addition of these two things. Theoretically, right? Everything that I began with plus what I purchased gives me everything that's available for sale. Well, in that case, everything that's available for sale is either sold and its dollar value is recognized in cost of goods sold, or it's still on my premises and is part of my ending inventory balance. Now, this is really a periodic equation, but we can change it just slightly to accommodate a perpetual system, because in the perpetual system, we include another possibility that everything I have available for sale either is still in the store, it was actually sold to customers, or, and let me write it just in black so it kind of differentiates it, it was ruined, stolen, rotted, whatever you might have, but it wasn't sold. It's part of our loss on shrinkage. And that is given to us only with the perpetual system. So I modified equation for perpetual system. So we can still use the ideas from the inventory equation when working in the perpetual system. We just have to be cognizant that the perpetual system allows us to identify shrinkage, and we can include that as a separate piece. The periodic system does not, remember, consider any shrinkage, and therefore just assumes anything that was stolen or got ruined or destroyed is actually cost of goods sold to the customer. Now, given this, thinking about GAFs again, and really just concentrate on ending inventory and cost of goods sold, this basically implies that as the amount of the cost of goods sold the amount of dollars I assign to cost of goods sold increases, then my ending inventory balance has to decrease because none of what I assume I sold, dollar value, is going to change gas. So as COGS increases, ending inventory has to decrease and vice versa. As ending inventory balance has a higher dollar value, that means that we sold less for every dollar of gas we have. That brings out the following sort of relationship that I will capture in a table. If we have LIFO cost flow method and FIFO cost flow method, then they both have effects on cost of goods sold and ending inventory. Now, in order for us to really understand their effect, we have to make an assumption about inventory costs over time. Because understand that, right? LIFO is the most recent purchases sold first. These are the oldest purchases sold first. And so since we're talking about recent and old, we really do have a timeline going on. Now let's say that this is time on the x-axis. And over here we got inventory costs. So the amount I'm paying for all my purchases. And who cares about the exact portion or period of time we're talking about? But basically, one fundamental truth is that even if they dip sometimes, inventory costs tend to rise over time. So up here, maybe we have $10. Down here in the middle here, we have 5. And maybe they started about 1. Who cares about the amount of time it happened? Generally, over time, inventory costs are rising. And this ultimately affects how LIFO is going to value the dollar value of cost of goods sold versus FIFO. Because if we think about this perhaps as just a single accounting period, and there was a crazy inflation movement on the inventory costs for this one piece, right? Then LIFO, if we're talking about selling what units we sold, LIFO is going to put these into cost of goods sold, those price points, because they're more recent than these older prices that are lower that will end up in LIFO ending inventory. And then FIFO is going to do just the opposite. FIFO will consider these to be the sold costs, and it'll put all of these into ending inventory. So during times of rising inventory costs, like the trend line here, LIFO puts the higher price points into my cost of goods sold, which means it's going to have a higher dollar value of cost of goods sold. It's simultaneously going to take these lower costs and leave them in ending inventory, which produces lower amounts of an asset, right? My inventory account on the balance sheet. FIFO is going to do the opposite, where it has lower cost of goods sold because it's selling these older prices, and its ending inventory is comprised of the more recent, higher cost inventory. So it reports a higher dollar value on my balance sheet in the inventory account. Remember, of course, cost of goods sold is on the income statement. It's an expense. And that my ending inventory is on the balance sheet as an asset. So not only do they affect accounts in various ways, but through those accounts, they're affecting a financial statement. And another way to consider it is that LIFO puts recent inventory costs, or recent information, because cost of goods sold is all about the inventory. It puts stale costs on our balance sheet. And we're going to see that in certain situations, if a company doesn't sell through the purchases it made during a particular accounting period, there can be some very stale costs in LIFO. FIFO, on the other hand, does the opposite. It puts the stale costs here and puts recent costs on the balance sheet. Okay, so it does not just a dollar value impact, but also has an impact on the usability, or how we can use these financial statements, where we can put more faith in the most recent information if a company uses LIFO versus it using FIFO.